Very good evening to all of you. Welcome to the practical session number 11 for the year 2024. Myself, Srijit Kakkar, and today is Saturday, 16th of March 2024. And moving ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. So today's session will be the practical application of demand supply methodology. So the demand supply methodology, which we used to teach in our paid courses, is now available as an absolutely free course. If you have still not learned the methodology, you wish to learn it, then you can look into the description. The link to the course content is available. They are available as playlists, so you can just go through the playlist and learn the complete process. It is available in both the languages, English as well as in Hindi. So whatever language you're comfortable, you can learn in that language. And that's the theory part. And the practical application is what we do in these sessions. So every weekend, I do a practical session where we apply the complete process to understand how to plan trades very mechanically, very rule based. Now, at the time of analysis, I do not disclose the name of the symbol we are analyzing because, like I said, the focus here is to understand the process. It's not about sharing any trading ideas. So yes, I do not share the name of the symbol at the time of analysis, but whenever it gets triggered and we do the review of it, at the time of review, I'll definitely be disclosing the name of the symbol. So we do have one symbol which got triggered during the week. We'll start with the review of it, and then we'll start with the practical application or the practical example for today's session. All right, so starting with the one which got triggered is take. So this is the one that we analyzed the last session. Now, when we did the analysis, I did talk about that the reward to risk ratio is not really nice, but since we are planning at the best location, the RR can be taken from the intermediate time frame, which was really good. So technically, it was a valid trade for us, but unfortunately, you can see the zone got violated, and this will be considered as a stopped out trade. Now, if you look into it, we did make a small little modification here that even though the zone was pretty narrow, we took the intermediate time frame zone, and that is how we, pushed our distill line a little lower. But again, I'm just showing you these examples because, like I said, some people can be conservative, some people can be very conservative. So, a very conservative trader, because we were also planning this at the best location. Can you see? So, the example which I was talking about, that when you have that lower time frame and the intermediate time frame, at times prices can go a little deeper. That's why we want to have our stop loss below the distal of the intermediate time frame. But even after doing that, can you see it stopped us out, and then the prices are reacting? But we have the similar case on the HTF as well, because here also you can see that in HTF we have fine-tuned our proximal line, but we have also fine-tuned our distal line. So yes, this is where at times if you want to be extra conservative, right? And again, it's not that it's going to happen with every trade, but I'm just showing you one step ahead, so that people who like to be extra conservative, if they want to make any modifications, they want, some people might be comfortable with missing a lot of trades, but they just want to take the best of the best trades, and some people might be otherwise. They want to take more number of trades because by the law of average, right, when we talk about the reward to risk ratios, yes, it is going to keep you net net on the positive side as long as your RRs are good. So, but yes, if you are on the other side of it, that you like to be extra conservative, then you can also see that my intermediate zones, we have two zones which were part of the higher time frame. So in that scenario, if you wanted to shift to the lower zone and wanted to further fine tune it, probably if your entry was just a little above, that is where you could have got your fill as well. But we will consider it as a stopped out trade. But yes, that's part of the parcel. This is something I always keep saying, that there is no such strategy where every trade is going to be profitable. You will have winners, you will have losers. So you'll have to accept it, can't do anything about it. But yes, as we have more number of examples as we move forward, you will see that you'll always have a mixed bag. Some will be winners, some will be losers, some will be break evens, right? And some can be very big winners, but we'll never be having a very big loser. And the reason for that is we always have our losses in control by using a stop loss. All right, so that takes care of the symbol that we did the analysis, and it also got triggered. And now that we are done with the review of it, we can start with our today's example. So just bear with me for a few seconds. I'll set it up and then we'll start with the example for today. So just a few more seconds and I'm almost done. All right, perfect. So this is the one which we will be analyzing today. Just give me a second. Right. So this is the one which we will be analyzing today. So whenever we talk about trading, I always say trading has to be a very mechanical and rule based process. And to make it mechanical and rule based, I have shared two documents with you. Now during the session, if I'm talking about some documents or if I'm talking about some videos, the links are available in the description. So do not worry, where you find those documents or where those videos are located. So just look into the description. You'll be able to find all the relevant links. So coming back to, because trading has to be very mechanical and rule based, but why it should be mechanical and rule based, for this I have created a video, and the title of that video is how to start trading. So in case you have not yet watched that video, do ensure you watch it and understand the process you need to go through, because there is no bypassing it. Eventually you will have to go through that process. The sooner you start, the better it is going to be for you, and that will also help you shift from a person maybe who is not very rule based and mechanical to being a trader who starts planning trade in a very mechanical and rule based way by understanding the logic behind why we need to do that. Just give me a second. All right. So, like I said, we need to be mechanical and rule based. So, when you are starting as a fresher, maybe, you've just started learning trading, or maybe when you are starting learning a new methodology or a new strategy, it's not very easy to create a trade plan from day one, because to create a trade plan, first you need to have a good enough experience with that particular process. And if you have good experience, then it becomes very easy for you to create a trade plan based on that. So to overcome this challenge, I have created two documents for you. One is called as the trade plan steps. You can also call it as the flow chart or the walkthrough, which guides us what we need to do as a demand and supply trader step by step. Now all these steps, they have their own elaborate rules, which you will be able to find in the rule book. Again, the rule book that I'm sharing with you is a conservative approach. With time, with experience, if you want to make some modifications to it, that can definitely be done, because there is no such thing as one size fits all, because everyone has a different personality style. Some people might be aggressive, some people might be conservative. So based on your personality style, those modifications can be done. But yes, this conservative trade plan is what we will be leaning against while we are doing our analysis during these practical sessions. So what is our step number one? Whenever we start planning our trade, step one is we need to define our trade purpose. So now the question is, what do we mean by trade purpose? Trade purpose basically implies the expected duration of the trade. And the duration of the trade is from the time you enter the trade to the time you exit the trade. Now, just give me a second. Let me do it again. Right. So uh, your trade purpose means from entry to the exit. So when I'm talking about the exit here, the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So now the question is, why are we starting with the trade purpose as a step number one? And the reason we are doing this is because when we do our analysis, the charts that we use, they are time based charts, and we have a number of time frames available to us. So the very first challenge we face is that so many time frames are available. So out of these a number of time frames, which time frame should I be using for my analysis? That's the very first challenge. And to overcome this challenge, we do not start by randomly selecting any time frame. We start by first defining our trade purpose, because logically, the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So what I've done is I have divided these trades into four different purposes, and we call them as hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where the expectation is that this trade can last for an hour or few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income, a trade which can last for a month or few months. Now, very important, even though by definition I said daily income is a trade which can last for a day or few days, but the markets which you might be trading might not be 24 hours market. So in such a scenario, my recommendation would be not to keep these daily incomes as overnight trades initially, because when you're learning something new, you don't have expertise from day one. With time, with experience, you'll start getting bit better with your analysis. You'll start building up confidence. So initially it is a good time to practice risk management by doing daily income strictly as intraday trades. But as you start having more and more experience, you can do daily incomes as overnight as well. So step one, we need to define our trade purpose, and let's assume I opted I want to plan monthly income trades. Now once I selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if I go to the rule book and we go to page number 28, we start with the topic that is multiple time frame analysis, because demand supply methodology is not based on single time frame. Demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames that we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. Higher time frame is used for demand supply curve analysis. Intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supply for our entries and exits. And the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like type 2 type 3 entries, or in case we need to apply some additional rules, that is also where this time frame can help us. So now I know what are the 4 different time frames I'll be using, plus what is the purpose of each and every time frame. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Like in this example, I want to plan monthly income trades. So as a monthly income trader, my time frames will be monthly, weekly, daily, and 60. Monthly will be the higher time frame, which is used for curve analysis. Intermediate will be weekly, used for trend analysis. Daily will be lower time frame. That is where we get our ACTS from. ACTS stands for stop loss, entry, target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. So as soon as I'm done with my step number one, now I have the clarity to what time frames I'll be using, plus what is going to be the purpose of each and every time frame. So in this case, we have monthly, weekly, daily, and 60. So my challenge number one is taken care. Next comes challenge number two, and that challenge is I do know my time frames, but on NSC we have approximately 2000 plus companies listed. So humanly not possible that I sit and analyze 2000 companies every day. So what I need to do now is I need to have a process in place using which out of these 2000 companies I can get a smaller list, because if I have a small list I can do my analysis almost every other day. But if I have to analyze 2000 companies every day, not an easy task. So how do I get that small list? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs they basically work is that we input certain conditions into them, that these are the conditions I'm looking for. And then these computer programs they identify that out of these n number of companies, which companies are matching with those conditions. So whatever is getting matched with those conditions, it gets shortlisted for me, and that is how we get a smaller list. So a few examples of these scanner screeners. Example one, if you go to my website, you will see under the free tab, I have created some scanners for you, which are based on some moving averages. And based on that, it is shortlisting some symbols for you. Second example, if you go to my YouTube channel and search scanner, you'll be able to find a few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis, which can again help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll be able to find a video on top-down analysis, which can again help you in shortlisting symbols. So these are 3-4 different examples of scanner screeners, which can help you in getting a smaller list of symbols. But you're not restricted only to these 3-4 different scanner screeners. Let's look at few examples. So like I said, once you go to our website, under the free tab, you have stock screener option. Because I opted I want to plan monthly income trades, I can click on MIT. I can run the long scan and the short scan. So here you can see that the long scan is generating 3 results for me, and the short scan is not generating any results for me. So this can happen at times that your list might be a very small list, or maybe you're not getting even a single result. Now, one thing which is very, very important you need to remember, irrespective what scanner or screener you're using, whatever results you get, you can never blindly buy or sell these stocks. So the job of the scanner is not to tell you that you need to buy this stock or you need to sell the stock. The job of the scanner is I can't analyze 2000 companies every day. So out of those 2000 companies, it gave me a list of only 3. So now I need to analyze these 3. Out of this 3, if anything matches with my trade plan, it might be my opportunity. But if nothing matches with my trade plan, I don't have anything available. So like I was saying, at times it can happen. The list might be a very small list like you can see today, or maybe nothing is getting generated. So if something like this happens, that you have a very small list, or even otherwise, let's say you want a little bigger list so that you can look for your trading opportunities, then what you can do is you can see that in this scanner, I have given 5 different conditions. You'll disable the third one and you'll run the scan again. And I'll do exactly the same thing here. Disable the third one, run the scan again. And now what you can see is that initially I was having only 3, but now I have a list of 163 from here plus 3 from here, around 166 symbols to look into. Now 166 is not a very big number. It's not like you have to analyze 1000 or maybe 500, 600. It's a very small number, which can easily be analyzed probably within an hour. But let's assume you feel that 166 is a very big number, you further want to filter it out, then you can use different filters. Simple examples can be, I can say I only want from the symbols which are getting traded in futures. I can run the scan again. Here also I can do exactly the same thing, not from cash, the ones which are getting traded in futures, run the scan again. And now you can see I have a list of 55 plus 2, which is 57. So can you see from 166, we are down to 57. Let's say if you want even a further smaller list, I can also say, okay, not just futures, I want only from my Nifty 50, and I can run the scan again. So here I'm getting still 2. And if I go here and change it to Nifty 50, now it is giving me about 18. So can you see we have around 20 symbols. So you can see you can make this list a little bigger. You can make this list a little smaller based on your preferences, based on different filters. But again, I'll add, whatever results you're getting, you can never blindly buy or sell these symbols. The job of the scanner again is not to tell you what you need to buy or sell. The only purpose it is helping us is from a bigger list, it is helping us go to a smaller list. And these are not the only scanners which are available to you. Example, if I go to the screener section, you can see you have over 150,000 scanners available on this website. Some are based on fundamental analysis, top left, candlestick patterns. If I further go down, range breakouts, then you have your bullish scan, you have your bearish scans. Then you have your intraday bearish, intraday bullish, you have your crossovers. So you have your n number of scanner screeners available to you, using which you can get a smaller list for you. And this is just one website. Similarly, if you'll do a Google search, you'll find a number of websites and number of scanner screeners using which you can get a small list for you. Now in this example, you saw that we got a list of about 166 symbols, but once you start analyzing them, few more challenges which you will realize. Challenge number one, you will realize that in most of the cases, the lower time frame might not have a quality demand area or a supply area on which you might be able to plan your trade. And the reason for that is because all these scanners I talked about, none of them are based on demand supply zones. They are either based on conventional technical analysis or fundamental analysis, which is why just because something is getting shortlisted does not guarantee that on the lower time frame you'll have a quality area available to you. Second challenge is that few of them which might even have some areas, demand zone, supply zones on the lower time frame, those areas might be far away from the current market price, due to which you might have a longer waiting period before the prices are back to your zone. And during this waiting period, whatever price action happens, it might also disqualify the zone by the time it reaches your uh, your demand area or your supply area. So these are some of the challenges you face when you have your scanner screeners which are based on either conventional technical analysis or fundamental analysis. And to overcome these challenges, we have also created two custom built tools which are called as the alert service and the demand supply screener. So what does alerts do? As soon as you have a formation of a demand area or a supply area in the lower time frame, it immediately notifies you. And since you will get the notification as soon as the leg out completes, your current market price will always be close to the zone. In case of screener, you can define in terms of percentage how close the current candle should be to the zone before it gets shortlisted for you. And that is how these two tools take care of both these challenges. Both of them are based on demand supply zones. So challenge number one is taken care. In the case of alerts, you get the notification as soon as the zone gets formed, so your current market price will always be close to the zone. And similarly in screener, you can define your proximity based on percentage, so it will always be within that range when it gets shortlisted for you. And again, are these tools mandatory? The answer is no. I just showed you over 150,000 scanners which are absolutely free on just single website. Similarly, you'll be able to find a number of websites. So those are a number of free options which are available to you, but not based on demand supply zones. Then you have these subscription based tools which are purely based on demand supply. This process can also be as simplified as, I don't want to use any of these scanner screeners. The only purpose here is to get a smaller list. So I just want to analyze maybe my Nifty 50 stocks, or maybe I have my own favorite list of favorite list of stocks which I want to analyze. So choice is yours how you get that small list, right? But definitely the more the process is in sync with demand supply areas, the higher is the probability that you might be able to find some good opportunities, and that too maybe near to the current market price. So it's your call how you want to get that list. But yes, you have a number of tools available to you. So whatever is the best fit for you, you can use that. I would definitely like to add, if you want to understand alerts or screener better, the link is available in the description for the walkthrough video. And for the alerts, we also have some demo channels available. We have for NSC, we have for MCX, we have for Forex. So you can join the demo channels as well and you can experience it. But yes, at the end of the day, it's your call how you want to get that small list. So let's assume wherever my process was, I applied that process. I got a list of symbols in which the very first one ABC, and that is what I want to start my analysis with. So what we'll do is now we'll go to the lower time frame. So the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, our time frames were monthly, weekly, daily, and 60. Out of which daily is my lower time frame. So I'll go to the daily chart. And on the daily chart, I need to identify zone. And by zone, we mean any of these 4 structures. It can be a drop-based rally, rally-based rally, rally-based drop, or a drop-based drop. So whatever the symbol might be, like I said, at the time of analysis, I'm not disclosing the name of the symbol. So you can see currently the demand supply zone indicator is applied. So I can just disable it for a second. Now, when we talk about demand supply methodology, I always say it's a price action based methodology, which means you need to understand how the price has been flowing, and based on that, we can identify our zones. Now, initially, when you start learning the methodology, our eyes are not trained to identify these structures. So we have started with a very mechanical process which we call as boring exciting candles, and I have made the boring candle indicator as an absolutely free indicator. You can use it for free forever. So you can see if I apply the boring candle indicator, it is telling me that these two candles are boring. Plus, if I'll also apply the explosive move indicator, which is also an absolutely free indicator, you can see it is also telling me this candle is explosive. So you can see, even if I'm using my free indicators, which is the boring candle indicator and the explosive move indicator, I have identified my explosive move. Just next to it, I have my basing. Just next to it, I have an exciting candle, which makes it as a you can call it as your leg in. So basically, we have a drop base rally structure available to us. So you can see that even if I was using my free tools, I can see this drop based rally. Even if I visually see, I can see this drop based rally. But the demand and supply zone indicator is much more advanced. It is also telling me it's a drop based rally, but it is further fine tuning the zone and telling me that this candle should be taken as the leg in. So that's my drop based rally. So whatever you feel is the best way to start initially, you can start with that. Definitely the demand supply zone indicator makes the process much more faster, mechanical, and easier. So during these sessions, I rely completely against this indicator so that I can do the analysis faster and easier. So you can see the indicator is identifying this drop based rally. So let's draw this drop based rally, which is our demand zone. So our step number 3, which is to identify the zone, we have already identified. Do we have a zone available? Answer is yes. Now, just because you have a zone on the chart does not mean you can blindly trade it, because what happens is there might be a number of demand areas, there might be a number of supply areas, but every demand or every supply might not be a tradable demand or supply. So how do we qualify which one we want to use? For this, we have certain rules which we need to follow. First, we look into certain criterias and we qualify the zone based on those criterias. After that, we look into the booster scoring, and based on that, we decide whether we want to use this zone or not. So the first thing we'll check is whether the zone is a case of level on top of level or not. So what do we mean by level on top of level? It's a very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So when your intermediate time frame zone ITF divides into multiple zones on the LTF, we call it as a case of level on top of level. So the first thing we understand here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate, which we call as a coinciding level. So if you have a coinciding level, it might be a case of level on top of level, but if you don't have a coinciding level, it cannot be a case of level on top of level. So if you want to check it, what we'll do is we'll draw our zone on the lower time frame, go to the intermediate, and on the intermediate you can definitely see we do have a structure which is a rally based rally structure. So I'll draw it but with a different color so that we can differentiate between the two. So definitely you can see the one marked in pink is my intermediate zone, the one marked in green is my lower time frame zone. So is my lower time frame zone inside my intermediate time frame zone? The answer is yes, which makes it as a coinciding level. And in such case, I would definitely like to push my distal line a little below so that I have the support of my intermediate time frame distal. So yes, it is a coinciding level, but not a case of level on top of level. But I definitely made a small little modification based on that, just to ensure that my stop loss is a little better location. So not a case of level on top of level. This zone is not because of a gap, therefore gap rules will also not apply. This is definitely a case of pivot and not authentic zone because it's a drop based rally. So we always consider drop based rally and rally based drops as pivot and not authentic zones. And to qualify them, we have two different approaches. One is the conservative, which says that before applying the boosters, make sure the move from the zone was able to violate at least one opposing zone on the intermediate time frame. And the conservative rule basically has two parts. One is you need an impulsive move on the intermediate time frame, and you also need an authentic zone on the refining time frame. So let's see if I apply the aggressive rule. Aggressive rule says the move from the zone. So you can see this is where the zone was formed, and then you had this leg out. So the move from this area should have violated one opposing zone, but not of the same time frame, of the intermediate time frame. So here you can see you had your intermediate supply, and when the prices they moved up from here, definitely violated that supply. So based on the aggressive rule, this zone now qualifies for me to be used as a area where I might want to plan my trades, provided other factors are conducive. So yes, as an aggressive rule, this is definitely qualified. Going with the conservative approach, we need an impulsive move. You can see also had that, because you can see this was my last pivot high, and when we moved above, we also created a new high. So you do have an impulsive move on the intermediate time frame, and on the refining time frame you need an authentic zone. And this is almost like a textbook example where you can see all these conditions are getting applied. So here you can also see we have a rally based rally structure, which I think the indicator should mark for us. Perfect. So you can see we have a rally based rally structure as well. So irrespective whether you're applying the conservative approach or the aggressive approach, in both the scenarios, this is an area for us which is definitely qualified. So let's go back. Pivot not authentic, definitely qualified. Unstable equilibrium, not applicable. So after applying all the applicable rules, was the zone qualified for us? The answer is yes. And now that we know that the zone is qualified, we can move ahead with the booster scoring. So if we start with the boosters, zone is definitely fresh, gets a score of 3. Strength, definitely an explosive move. Time is very few candles. Reward to risk ratio is an assumption because based on the arrival, RR can change. Now the next thing is your location. Location will be on the monthly because we are planning a monthly income trade. And you can also see that we do have a rally based rally structure here as well. So can you see, something which just happened with the one which we were just analyzing, take, right? Here also what might happen is, because if you think about it, this was your intermediate time frame demand zone. You have fine-tuned your proximal, you have also fine-tuned your distal. So what if prices they go a little deep, stop you out, and then start going against you? But here the difference is not much. You can see we are pretty close to the distal line of the higher time frame. So I would like to make that small little shift just to ensure that my stop loss is at the safest location, and that's the modification I've done. And based on this, now we can plot our zone. So again, I've taken the distal from the higher time frame because it was pretty close to it, and definitely makes sense why not to have our stop loss below that. So yes, it was definitely at the best location. We have already verified that, and we also made some modifications due to which our distal line is shifted a little below. Now talking about trend, whenever you're planning trades at the best location, trend becomes irrelevant. Doesn't matter whether it is up, down, or sideways. All three of them will get a score of 1. Move from the zone, we need minimum 4:1, which has already happened. It is not a case of level on top of level, but definitely it was coinciding. And talking about trap, in a way is irrelevant. Why? Because we already have a score of 6, which makes it as a high probability trade setup. So whether we get 0 or we get 1, nothing changes, but this will be a score of 1. And the reason for that is, if I just take a horizontal line wherever the proximal is and start pushing it up, you can see almost this area. In fact, I can bring in more history, right? You can see almost this area has been acting like resistance, has been acting like support, has been acting like support has been acting like resistance, has been almost acting like support, acting like support, acting like support, acting like resistance. So you can see we have a pretty clean area of support and resistance, which is just sitting right above our zone, and that will help this zone probably work like a trap, because people who believe in support resistance, they will buy at support, and their stop losses will be sell orders, which will be placed below. Similarly, if we have a breakout, then the breakout traders will also be selling. So we understand by the time we enter this area of demand, we'll have a lot of people selling because of these two reasons and making two novice mistake. Mistake number 1, can you see they are selling after a huge decline in price? And mistake number 2, selling in an area where the chart has proven to us that back in history demand exceeded supply. which could be the only reason for prices to move up. So definitely we do have that possibility that this might work like a trap, due to which I've given it a score of 1. So if you look at the overall scoring, we have a score of 10 out of 10 for quality, 7 out of 8 for probability, makes it a high quality, high probability trade setup, which can be traded as a type 1 trade. So yes, it is a type 1 trade for us, but doesn't matter how high the quality or the probability. We understand any trade can be a stopped out trade. So we also need to be ready for the worst case scenario, for which we'll do a proper position size calculation, so that if it doesn't go in our favor, it goes against us. I should not be losing more than what my trade plan allows me to lose. Now, whenever the prices are back, we'll have to re-verify, does it still match with our trade plan, because the markets are not static, markets are dynamic, conditions are changing almost every other second. So we'll have to double check it is still matching with our trade plan. If it is qualified, we'll place our order based on the entry type. And once your order has been executed, the last step is your trade management, where 1:1 will make it break even. And after that, if you get the opportunity to trail onto it, we'll start using our trailing stop loss. So that's how we plan trades, very mechanically, very rule based. And now I'll be looking into what we have in the chat box. I'll take some random questions, queries. But before we do that, I would like to add, if you're not subscribed to my channel, make sure you subscribe to it, because generally I do these sessions on the weekends. Though the timing is not fixed, I prefer to do it on Sundays, but based on my availability, at times I might do it on Saturdays, even on Fridays at times. So at least if you're subscribed to my channel, whenever I schedule the session, you'll get a notification for it. If you're available, you can join in live. If you're not available, later you can still watch the recordings. And yes, if you're liking these sessions, do like the video. And if you have any questions, queries, you can definitely put it in the comment section. I try to answer all questions as soon as possible. And last thing is, yes, if you have some friends, family members who are into trading, or even if you're part of some trading groups, I would highly appreciate if you can share the link to the course content, or to these videos, so that people can take advantage of it. So let's get into the chat and see what we have. And like I said, I'll take some random questions, queries. So the first one is, please share the fee scanner and indicator. So it is available on our website, because we have a number of options available. So I'll just quickly tell you a few things which you can keep at the back of your mind if you're trying to go for these tools. So basically we have 3 tools. One is your demand supply indicator, which you can see is plotting the zones for us. The second one, so that's the first one. The second one is the alerts, and the third one is the scanner, screener, right? So basically what happens is, if you're subscribing to alerts, or if you're subscribing to scanner, by default you get demand supply zone indicator complimentary. Now some people might not want alerts, or they might not want scanner, they just might want demand supply zone indicator as a standalone indicator. So that option is also available. So yes, if you're going for alerts or screener, this you already comes complimentary during the subscription duration of your alerts or your screener. And if you want to go standalone, you can go for demand supply zone indicator as a standalone subscription as well. Plus some people might want to have both of them, so it's not required you buy these two separately, because that will again be expensive. We also have a fourth product where we have clubbed alerts plus screener. So your number 2 and number 3 have been clubbed together, and again along with that you'll still get the access to the demand supply zone indicator. So whatever you feel is the right fit for you, you can go for that. Plus they are available in different subscription options. You have 30 days, 60 days, annual. So the bigger the subscription length, the bigger is the a discount on it. So if I remember it correctly, I guess on the 60 days subscriptions you get 16% discount, and I think if you're going for annual you get 30%. But I'm just giving you some rough numbers. Exact you can see on the website, because I truly don't recall what is the exact discount, but yes, you can definitely check it on our website. Or how to make supply zone when there is a gap, and the candle before the gap and the one making gap are boring candle, and then we have an explosive candle. Okay, let me try to draw it. How to mark a supply zone when there is a gap up. See, the first thing is, if you have, okay, let's assume there is a candle here, and then we have a gap up. So what I'm doing is, I'm assuming this gap up as in dotted candle, just to understand what we are trying to mark here. So we have a gap up, and the candle before the gap, there is a gap up, and the candle before the gap. So this is the candle before the gap, all right? And the one making gap, okay, and the one making gap. So this is basically the gap. Let me try to read ahead. our boring candle, and then we have an explosive candle. So actually I'm not able to get what you're trying to point here, because unless and until I have a clear understanding of this is the kind of structure, I'll not be able to answer it. I tried to replicate what you were explaining, but I'm not able to replicate maybe correctly. So if you can give me in a much more cleared way, or maybe next time what you can do is, no, I don't think there would be any other way to do it, because you'll have to tell me, okay, this is how the structure is. Because unless and until I understand the structure, I'll not be able to help you with it. But definitely, what I can do is, I'll try to do a session soon where maybe the zone is because of a gap, and then we can take gap example. In fact, what I can also do here is, if I just change the indicator settings for a minute, that I'll say that identify overnight gaps. And hide non-gap zones. So now you will see it will identify all gap zones for me. So I can just show you as an example. So here you can see you have a example of a zone which is because of a gap, and I can more also do here as okay, let me not change anything else. So you can see all these zones which are now getting marked are because of gaps. So here you can see we came down, then we had a gap down. So the thing is, the day we had a gap down, we got the fill the same day. The gap was filled, and then we started moving down. So that is why it is a test. It is a tested zone now. If you're talking about an example of a fresh zone, so here you can see we have a drop base and a gap up. So whenever you see a gap, the easiest thing is just imagine that gap as an invisible candles, and this is your leg out basically. So here also you can see an example. So this is again a good example. So what you can do is you can assume it's something like this. So this is my leg-in, this is your basing, and whenever you have a gap, like I said, just imagine that gap as an invisible candle. So once you're imagining it as an invisible candle, that's your leg out, right? So we have a drop base drop structure now, and that is what the indicator is marking for us. All right, so now let me disable it, because I generally keep gaps as disabled, because almost every other day, every stock is gapping up, gapping down, so it create a lot of zones on the chart. That is why I like to keep that disabled by default. But yes, if you want to enable it, you can also enable it, and the indicator is gonna mark it for you. All right, so why does type 2 type 3 entry does not work in Nifty futures and many times as type 1? See, it's not that type 2 type 3 will not work, but if you're saying that the probability of getting the entry is a little difficult because prices might just touch and move away, that is something I'll definitely agree to, because when you're doing type 2 type 3 entries, you have to wait for a certain time before you have those bullish candles or bearish candles, and by the time those candles they are formed, prices might have already reacted from the zone and you miss your opportunities. And eventually you will see, the better you start getting with your analysis, the more you'll start leaning against type 1 trades and lesser against type 2 type 3 trades. What are the reasons for type 1 entry to get stopped out? See, again, it's not just what are the reasons for type 1 entries to get stopped out. Fact is, you do any style of trading, you will always have stopped out trades. If you are looking for a strategy where you do not have even a single stopped out trade, that is not possible, right? So yes, some trades will go in our favor, some trades will go against us, and the biggest problem here, I'll say, is it's more on the way we have been taught from day one. Now, what do I mean by that? The way we have been taught from day one. So from day one, we learn, okay, if it is 1 plus 1, it will always be 2, and that will remain constant, right? If you take chemical A, you take chemical B, and you mix it in the same proportion, you will always have the same chemical reaction, and you will always get the same output, which is, let's say, chemical 3. If you take color A and you mix it with color B in the same proportion, you'll always get color C. You take one ingredient, you take the second ingredient, you take the third ingredient, mix it in a particular way, the same ratios, you will always get the desired dish. So whatever we have been learning from day one is, if your inputs are the constant, your output is always constant, right? That is what we have been learning, but that does not apply to trading, because in trading what happens is, uh, condition 1 is true, condition 2 is true, condition 3 is true, you have a winning trade. Next time condition 1 is true, condition 2 is true, condition 3 is true, you have a stopped out trade. So that is where we start going wrong, right? Then we think, okay, there has to be something wrong with some of these conditions, and that is the reason I got stopped out, because if my constants were same and it was a winning trade, next time it should also be a winning trade. But we don't understand that when it comes to trading, it is not about constant and a constant output. It is more about when your inputs are constant. your output will have a higher probability which will be winners, right? If that is what it has been showing in the past. But in between, you will also have losers. And the reason for that is because the market works on human psychology, right? It works on human psychology, which can act in different ways based on the same input. And that is the reason, that is where we have to make that shift. So just because, we are getting stopped out does not mean that type 1 trade is the wrong way to do and type 2, type 3 trade is the right way to do. Fact is, irrespective what methodology you're applying, irrespective whichever way you're approaching the markets, you will always be having losing trades. And that is why you have to create that mindset, and that is the reason I have that video, which is how to start trading. So once you go through that video, you start that process, that is how you start learning and understanding that yes, even if my approach is constant, my output will be constant in most of the cases, but not in every case, right? That is how I can put it. So that is one thing you need to understand. So it has nothing to do with type 1 entry or type 2 or type 3. It is a fact that markets are such. You will have winners, you will have losers, you have to accept it. And that is why reward to risk ratio is a very key important aspect of any trading strategy. Okay, while investing, should we use monthly income, price, demand, or should we just buy at the. So it's, see, again, if you're buying, it is always better to bargain on the price and buy at your price, right? So waiting for the prices to come into the demand zone would be the right way to go. Absolutely, you might miss some trades, but that's part of the parcel. Like I already said, you will have some trades, you will miss some trades, but it definitely makes sense to bargain for the price and get your price, if possible, and then only enter the trade. All right, so that takes care of our today's session. Next, we will be catching up next weekend. I don't know whether it's going to be Saturday or Sunday. In fact, this weekend I was expecting I'll do the session on Sunday, but due to some reasons, I had to do it on Saturday now. So I'll see you next weekend. Till then, trade safe. Enjoy your Saturday and Sunday. Enjoy your weekend. Take care. Bye bye.